Okay, here is the consolidation worksheet, and I'll just point out a few things along the way. This is pretty straightforward, except for the fact that you got the non-controlling interest. But the numbers are all what we've already sort of worked on. Let's just see how we can put everything together. First of all, let's just do the S entry, follow that along. You see the S entry gets rid of opening retained earnings, gets rid of the additional paid in capital and the common stock. That's S entry, and the credit's going to be to the investment account, with an exception to the fact that there's a non-controlling interest. So if the total of the S entry on the debit side right now is 500 plus 300 makes 800 plus 880,000, that is the debit side. That 90% of that is 792. So that goes as a credit to the investment account. You see it? Wow. And then the difference between 880 and 792, which is, I just subtracted the wrong numbers, so that really helps. But it turns out to be, when you do it right, it's 88,000. And there you see the S entry as a credit to the non-controlling interest. That's the S entry. We split it between the controlling interest at 90% at the end of 15 and the non-controlling interest, which is 10% at the end of 15. Okay, let's clear the deck and look at the next entry. Let's do the A entry next. So the A entry, if you recall, is we're going to book both the trademark, or the copyrights in this case. There's the copyright, so we're going to book the difference. Now the difference now is that this is at the end of the, we want to do the A entry at the beginning of the year. That's just like the S entry was done at the beginning of the year with retained earnings. Same thing with the A entry, but it's after 1 year of amortization. So it was 120, if you remember, 120K. 20,000 is amortized each year, so 14 went by, and so the opening amount for 2015 is 100, and there you see it. There you see it, there you don't. We knew that the goodwill, we calculated the goodwill in our last video at 25, and there you see the goodwill. So the A entry's got those two numbers, that totals 125. The credits to the investment account, but be careful, it's 90% to the investment account and 10% to the non-controlling interest. So 125, take the calculator out at 90%. Oops, take the calculator out and do it right for a change. 125 times 90% should be 112.5, and there it is. There's your credit, 112.5, to the investment account for the other part of the A entry. The difference is 12,500. That's 10% of the 125, and that balances the A entry, and you're done with that. Now you're really cooking, because you're creating your non-controlling interest and taking care of your investment account through the A and the S entry. Get a drink. Next step. Let's look at the next step. The next step is let's do the D entry, the retained the dividends. So the dividends gets broken down. It was 60, but it's 90% parent, which is a debit to the investment account, and then 10% to the non-controlling interest. It's shown in this column because it's going to be part of the change of the non-controlling interest from the beginning of the year to the end of the year. Beginning non-controlling interest to the end of the year, so we show it in this column here. That's simply the convention that this textbook uses. There are at least dozens of other methods of doing the consolidation worksheet, which just makes for fun and games when you get out into the work field, but it all ends up at the same in this column. That's the good news. All right, let's clear the deck and look at another entry in these consolidation entries. Let's do the I entry, which is the income. And so what we know there is the income equity method recorded on the books of Mr. Parent is going to be debited to get to zero. The offsetting entry is to where it was put on the books of the parent, which was the investment account. So we're going to credit the investment account. Initially, it had debited the investment account on the parent's books. Now we're reversing it. So we take out the income and we take off the investment as a credit. And then the I entry is done. Give ourselves another double check mark. And we're done with that. Now we move to the E entry, which is going to record the amortization. It's 20,000. There it is. We're adding to the operating expenses. And it comes off the copyright. Pure and simple, right there. And we're done with the E entry. Now that copyright is recorded at the full amount of the $20,000. That is true, but 10% of that is going to go to the adjustment for the income of the non-controlling interest. So what do I mean by that? Let's seek for knowledge and find out. Okay, what we're seeking to find out is what is the income that belongs to the non-controlling interest. There are a couple ways to do this. Let's do it a couple ways, just for the heck of it, for good practice, and also to make the professor work even harder than he should. Okay, so let's look at it first from the standpoint of what was the income from the sub, 180 in total, but we have to adjust it for the $20,000 of amortization, so that would bring it to 160. 10% of that, which belongs to the non-controlling interest, is, how do you like that? $16,000. That's one way. Let's do it another way. How many ways can we do it? Don't answer that question. All right, 180, take 10% of that, it's 18,000. Now take 10% of the adjustment for amortization, that's 2,000. Take it off the 18. And what do you get? 16,000. How do you like that? Oh, and you thought I couldn't do this. One more way. All right, here we go. We know the equity method is at 90%, 144. That was done on the parents' books for the year. 144 extrapolated up to 100% by dividing it by 0.9. You get 160. Take 10% of that, and you guessed it, 16,000 is the amount of income belonging to the non-controlling interest. So there you go. How many ways can you go around the world? I don't even know what I'm saying, so if there's something wrong with what I said, don't even bother trying to figure it out, because I don't know what it is. At any rate, look what happens. The 16 is the amount of income to the non-controlling interest, and so when we get to this side of the equation, which is the consolidation, we're going to have the total consolidation income calculated by bringing everything across. That's the total company amount, but of that amount, 16 belongs to the non-controlling interest, and the remainder belongs to the parent, and it'll be called that, net income attributable to the parent. That 346 is amazingly, because of the fact that this is equity method on the books of the parent, is amazingly, you'll be amazed to find out, it is exactly equal to what's on the parent's books. And why is that true? Because that makes sense. The net income of the total consolidation is the net income of the parent plus the amount of income, 90%, of the subsidiary. And that's exactly what this line means. This line means, can you read it? You can't? Okay. This line means net income attributable to the parent, its own income, plus the income it recorded by the equity method for its 90% ownership in the subsidiary. So that's why it works out exactly equal to that there, these two numbers. So that's a check on your work. All right, let's move forward with other interesting extrapolations, which I asked you about to do for your homework. So these may be just a review, and if you didn't get it right, this is great for you to now know it. Let's look at the investment in Keene Company. This represents 90% of the ownership of Keene Company. So let's do it. 994,500 divided by 0.9 gives us 1105. Take the difference. Now remember, this is at end of year, after equity method has been applied throughout the whole year. Take the difference, and you get 110.5. Oops, sorry about that. You get 110.5, which happens to be the ending balance of the non-controlling interest in the equity section. That's not magic, my friends, even though it looks like magic. So the end-of-year investment account on the books of the parent represents 90% of the total equity of the consolidation statement. Of the total equity of the consolidated statement, 90% is going to be shown as part of the parent. 10% will be part of the non-controlling interest, hence that number. Now, if you didn't know the opening non-controlling interest, you could take this number and then work backwards. What was the income? What were the dividends? And you can create what the opening non-controlling interest must have been, which in this case is the 100,500. Those are amazing facts. Now the other thing is, since we're doing the net income of the parent that's attributable to the parent, which means its income plus its 90% of the subsidiary, and that's the number we're adding into the retained earnings. So the retained earnings that we get at the end of the year for the consolidation, which is $1 million in this case, gets carried down to here, and so it is the amount of retained earnings that's going to show on the consolidation. And when the parent does equity method, it'll be exactly in agreement with the parent's books showing retained earnings at the end of the year, $1 million. Another non-coincidental fact, and there is what you got. So send me your dollars. Send me your questions, and I will address those through either another video or in class or June 30th, 2017. So you take your pick. See ya.